Good afternoon. My name is Antonio Zuniga. I'm the managing director at Oakshore Capital. We're an investment management firm buying alternative asset classes, primarily in the consumer debt space. So we buy charge-off portfolios and then allocate them into diverse funds to create monthly cash flow that is front-loaded and first.
Okay, Shalako Viener. I'm the head of global trade finance for Bank United. So Bank United, the largest Floridian bank and Republican trade.
Good afternoon, Jeremy Todd, head of capital markets at Prime Meridian Capital Management. We are a $600 million hedge fund firm managing 4 primary strategies across marketplace lending and specialty credit. We have a consumer-focused fund, a business fund, a real estate fund, and a special opportunities fund, which does litigation, finance, and life settlements as well.
Hi, I'm Jeffrey Marin, the CEO of Sheridan Asset Management. We've been in business 17 years. We lend money on a senior secured basis to specialty finance companies in the consumer, commercial, and esoteric area. We also provide senior secured financing to groups that buy distressed financial assets. And our third sleeve of business is we look for novel origination businesses where we can grow the origination basis in things that maybe can't scale, like large ticket opportunities, but provide a good opportunity with both attachment point and risk reward.
One thing I forgot to mention when we started, everything we say is sort of our own opinion speaking ourselves, and it should be off the record. I guess with that, Jeremy, where do you see opportunities in, I guess, direct lending opportunities and direct investment opportunities?
Yeah, well, we, like I just mentioned, invest in quite a few different sleeves, if you will, or different verticals, depending on which vernacular that you want to use. We were founded in 2012, which isn't that long ago, relatively speaking, but for the marketplace lending space, I think that puts us as kind of one of the first 1 or 2 or 3 managers within the space, as well, just as an additional side note on our firm. In terms of opportunities, we do see quite a few opportunities. We think just with our size, being a dedicated manager in the space, we like to think we have a pretty good reputation in the space. So we do get quite a bit of first looks at some of the smaller originators in addition to some of the larger ones that we invest in. And in terms of the opportunities, we're seeing some interesting opportunities in the point of sale space, which a consumer play, but instead of doing an unsecured consumer loan like through a lending club or Prosper, which typically goes to credit card debt consolidation, the point of sale is when the loan actually gets paid directly to the merchant, and there's some interesting risk return opportunities there that we like. We also are seeing some interesting opportunities with regards to more the middle class American loan, so maybe not your typical prime loan, again, that you might see at a lending club or Prosper as well. So there's a good firm that's growing quite a bit here in New York that we have a great relationship with and have a sizable investment in within their loans. And then we also are seeing some additional credit opportunities as well and some niche opportunities as well, which I'm sure we could talk more about in terms of this panel as well. Maybe I'll talk more specifically in a few minutes on that. But we are seeing some great opportunities on the consumer side, which is a little bit of maybe oxymoron is too strong of a word, but a lot of people think that the prime consumer space has had some challenges with where we're at in the credit cycle, but we do see some good opportunities more in nichier originators within the space. And frankly, like I mentioned, we're also, over the past year, investing in litigation finance cases and life settlements, which is within the alternative credit space, and we're seeing some great opportunities there. The fund just had the 1-year anniversary of performing quite well, and we're pretty excited about that fund and getting a lot of demand there as well. And there is still some interesting plays even within the real estate space as well. So maybe that's a long way of saying we're seeing some interesting opportunities across the different verticals. But it's really a matter of finding those niche originators that have that good risk return profile and not necessarily just buying from the largest players in the space that offer good loans, but loans that frankly most people could get access to pretty easily. So we try to use our size and reputation and history to find some nichier plays that maybe others can't find access to.
Sure. We've found, I'll give you sort of three examples of things we're doing now that we think are interesting. On the consumer loan side, we've been involved in providing senior secured financing to a debt settlement company and an affiliated company that originates consumer loans on a consolidated basis to consumers. But the novel nature of the loans that are being originated there, and that's what we try to do when we find origination sources that we want to grow. In this case, you're taking a captive audience because you've got a consumer, as an example, has made 6 or 7 payments in their first escrow when they're trying to solve their debt issue. Once somebody makes 6 or 7 payments, typically the pull-through is like 87 to 88% that they finish it. So you take a consumer that has the willingness to pay, then you re-underwrite it, and you get the ability, and then we put a 85% advance rate in an SPV that the company formed, where we're getting paid a 15% coupon, where we have an 85% advance rate against collateral that we believe has coupons, in the mid-20s, but cum losses relative to the traditional platform originators at a significant difference from a loss perspective. On the litigation finance side, and our specialty is always small to mid-size finance companies where we can at least extract what we call on a lending basis first loss capital to protect our downside along with the collateral, better covenants, and a better rate. And so in the litigation space, we are doing something in what we call the LOP area, and that's letters of protection. That's the medical procedure in the personal injury matter. And so, we're, again, providing a senior secured opportunity against the collateral. And typically, in this case, the payoffs are typically on the underlying collateral are like 6 months. So what we try to do to get optionality is we lock them up for 3 years, have the option to finance them for that period of time so that you don't just get left with the dregs in your portfolio. And the third opportunity, just to talk about is in the MCA space, but with a very conservative advance rate. And for people that don't know the MCA space, we've got a 75% advance rate, which means the company's putting 25% first loss in front of us, and we're advancing 75% on the cost of the loan. And typically, the yield on these things on an ROI basis is typically like 1.2 times. So you're advancing 75 on 1.2 times of an asset. So we think we have good asset coverage and return profile. Again, we're getting in the mid-teens. But I think like the rest of these gentlemen will tell you, you got to work hard and you got to look at a lot of nooks and crannies to find things that you can price right that the other liquidity hasn't gotten to, because there's lots of capital out there chasing these opportunities.
Yes, on that.
So I'm over here on this side of the table, but just to give you some perspective of Oakshore, I sit somewhere in between Jeremy and Jeffrey. So we're not originating. The long background in real estate and lending, both private lending on real estate as well as FDIC insured community banking. What we're taking over is we're taking the portfolios 6 months plus after the last payment. And so like any investment, we make our money when we buy and we get paid when we sell. And so for us, the risk, and we'll get to I'll tie it into the dry powder. There's always more money chasing, there's infinite money chasing very finite traditional deals. So our strategy has always been finding niches that we understand and like, and then I want to be better capitalized and have better process than the smaller player. So the smallest deal I want to look at is going to be too big for the small guys, and the biggest deal I want to look at is too small and of not interest to the large institutional players. And from there, it's just that's where we've always found alpha.
Okay. I do supply chain finance. I don't know. This is today, trade finance is an asset class. It's not be very well developed, at least in the United States, as an investment because of the perception of the return is too low and the speed to market. But this is the interesting part today when we see a excess of liquidity and looking for opportunity that the risk return makes sense. Today, to give you an idea, around the world, there is around $55 trillion in cash traps in companies. And this is simple. Everyone has to pay their supplier and collect from their clients in order to make their return and their growth. So everyone that have a receivable today can monetize that. And depending on the risk that you want to take at the position, you can have a different kind of return. This type of product that I've been working for 16 years, it was very used by large corporations. Fortune 500s have all their supply chain programs, and they discount the Walmarts, the Coca-Colas. Keurig is coming out of bankruptcy basically because of supply chain financing. So this is something that, being the subject of our panel, the co-investment, this is a big challenge for the banking industry today because there is certain asset that because of regulation, because the underwriting process, the compliance process is a burden when we want to give a full scope of possibility for our client to discount all the receivables. There is certain receivables that we can underwrite, they are not bankables, but for funds, they're very interesting opportunities because we structure all the operations. So if we partnership between bank and fund, there is an interesting risk return. And I'm talking that this is 60, 90, 180 days maximum. You have return between 5 to 10% in that period of time, which really good names. This is no leverage. This is in the operating cycle of companies. A lot of people think this is very sophisticated, but this is banking 101. This is invented in Florence by the Medici family. Someone have a product, they want to sell it, but they have a gap in cash. Someone want to buy it, but they want to be sure that the product is there. So you are the one selling the time, which is basically the role of the bank is selling time, no money. So this is, we'll say that you're going to see more and more aggressively growing in the United States, and it will be very interesting. I know there is a lot of fun looking at. This is a different kind of opportunity to place the excess of liquidity in the short term and get an adequate return for the risk that you were taking.
So when we were preparing this, we were looking at sort of what might be bubbles in the market and where we perceive the caution. And I know that Jeff had some ideas that he wanted to start and lead off with, so I'll let him start, and we can go right down the line.
I'm just somebody who lived through 08 and 09, and so I'm very asset liability driven. And so I just think, like anything else, where we are in the cycle, depending on the types of assets, and depending on the liquidity structure of your vehicle, you really got to pay attention to, asset liability mismatches when liquidity starts coming out of the market. Some of the subsets, like anything else, the fix and flip market, the real estate bridge loan market, and quite frankly, some of the other verticals, there's a lot of risk capital out there that we're seeing on the financings we're doing, how aggressive people are to put those risk assets on. So the advance rates, meaning you lend at a more aggressive point in the capital structure, those things are more often than not. The LTVs and the coupons that the underlying originators are charging are getting way more aggressive. So, our view on a credit basis is you have to look at the absolute return, the ROI, the cash-on-cash return, because that's truly your margin, not the time value of IRR. But as my colleague said, like in the charge-off space, we've been in that space 25 years. There are opportunities in there, select opportunities where if you find an avenue where you find a channel where it's not as well served, you can still find value. And I think that's really what you have to do across all these spaces is try to find the channel that makes sense and be cognizant of where we are in the cycle and really pay attention to how your liquidity is structured in your vehicle to make sure that if there's a downturn, that you have the wherewithal to meet the margin calls and to be able to support the assets if they need additional liquidity.
I'll add to that. So I spent about 20 years on Wall Street within a division called Prime Brokerage, which was providing financing to hedge funds. So I worked with probably about 1,100 hedge funds over a course of 20 years, and I think saw quite a bit of what worked well and what didn't necessarily work well for hedge funds, and including the use of leverage and operational infrastructure. And it's in this asset class, it's, I think, critically important, just like it is for any asset class. When I left Wall Street, I started investing personally in this asset class about 7 years ago. Went to a fintech startup that was kind of like a quasi Bloomberg for this asset class. Worked with about 30 managers that were managing assets within the marketplace lending space, P2P space, whatever you want to call it. And I think today, just 4 or 5 years later, the number of managers in the space has been reduced from about 30 down to about 10, including a very high-profile blow-up that happened just a few months ago with the manager that was managing about $700-800 million, who didn't have any prior money management experience, and sure enough, overly concentrated, used leverage, and unfortunately for the investors are now out of business, and it's a problem. So the point being is, when it comes to managing investments within any asset class, you need to have good risk management expertise, hopefully prior expertise when it comes to managing assets. You need to have the right infrastructure. When I would deal with the largest pensions and endowments, half the reasons why they invested capital was operational robustness and safety and soundness of assets, and not just performance, for reasons that I think most of you appreciate here in this room. And so within our business, we try to be very cognizant of what's called the basic things. We don't use leverage in our core strategies. With regards to the way we construct our portfolios, we think it's not rocket science, but it is important. So our real estate fund, for example, I think is a pretty good just example of how we go about managing portfolios. We within that fund manage it's all first lien only loans. They're typically bridge loans with 12-month terms, 65% average LTV. There's no mezz, no second lien, no equity within that. We buy across 6 different originators. It's very well diversified in terms of geographic location. It's about 40% here in the Northeast and 20% West, Midwest, and Southeast. But in order to construct the type of portfolio, like I mentioned, we're not just buying from one originator, we're buying from 6 different originators. And it takes a lot of time and energy when it comes to managing cash drag and getting the right percentages. And it takes a lot of work. And it's a lot of active selection. And you need to be able to have access sometimes to fractional loans in order to keep the balance in weight. But it takes a lot of time and energy when it comes to risk management and doing the basics. And we think that's why we've had a positive 3-year track record, average 8% every year, no down months. But in order to do it, and we think do it right, it really takes a lot of work and dedication. And again, getting access to certain originators, because as Jeff mentioned, getting access to the largest ones are easy, but getting access to the right mix and match of what you want from your investment objective standpoint is really not easy when it comes to managing assets within this particular asset class. And we try to be very cognizant of that when it comes to each of the verticals that we invest in.
Yeah, if you really want to have a sense of the market, and again, this is personal opinion, if you stop buying, it's because you're not selling. So when you invest in supply chain finance, is the first sign that you can look is that if you take a longer time to collect from your clients, you need to push your suppliers. So at the end, all these red flags, and I proved this in 2009. I made a bet with my real estate colleague who's going to collect faster in 2009 what we have on the street. And in 90 days, I have back $300 million in the portfolio of the bank, so in the treasury of the bank. And believe me, he's still collecting from 2009. the major risk when you do trade finance, supply chain finance, is fraud. So you need to build the right structure and understand the flow. But it gives you another tool when you're a fund and you want to invest of the sense of the industry that you're working on. Because it's like, you know, you see in the retail, and before being a banker, I work on consumer products. So I'm very sensitive of the way that you have to be efficient and perform. So as quick you can turn around the money and get it back when there is a lot of uncertainty in the market, you're going to be in a better position. So you need to diversify between all these kind of product, but definitely if the return is not the highest, is the visibility, and even if it's an unsecured business, it's been more secure than any other business that you have to rely on collateral if you want to collect something. Here you're going to react way ahead of anything hitting you except for fraud, and that where you need expert on the area in order to cover fraud and have a legal background. So that also help a lot. So having a good lawyer and build everything in front before you start doing supply chain finance.
So I think it was proceeding with caution and the trends. As investors, all of us in this room, for me, one of the largest risks I feel we have every day is overpaying for a good asset. And so as we start, whether we're at a top or not, I start worrying when taxi drivers are jumping into property flipping. And a big concern is always chasing the Joneses, while sitting in cash isn't a strategy and waiting. So I guess what we all have in common is, I guess, a love for many of the alternative spaces that are not correlated to the traditionals. What brought us back to consumer receivables in 13 and 14 was valuations and cap rates that just stopped making sense. The no-brainer days of 2007 to 12, it was a great time. But being an optimistic contrarian, it's a bit of a bipolar time where if you think you have something that no one else is valuing, you wonder, what does everyone else know that I don't know? But yeah, just doing your homework, not for us, not overpaying, and sticking to what we know.
Sounds like there was two themes there. One was leverage and proceed with caution where there's leverage, and understanding where the leverage is, and understanding how much you're supposed to pay for things, or if there's a fraud in the product. One thing we talked about when preparing for this, you want to?
Yeah, and the third thing is mismatch of non-QSEP, non-liquid assets to what your fund liquidity is. I think that was, a big lesson learned in 08 and 09. And I think that's the third rail, that comes with either leverage or overpaying for the asset.
I was going to say, I think on that point, a lot of people think they have great assets and great loans right now, and they're valued at par, above par, but it's not really clear what's going to happen with them because they have no covenants. I know we had some strong views within the panel about what that would look like. I don't know if anyone wants to start on that, even despite all the dry powder.
What was the question?
I guess what we think the risks of leverage, we hit on it a second ago, but there's so much more leverage in the system, even though there's more dry powder than last time. And I think there's a lot of hidden leverage up at the fund level, in the GP level, many more levels in our fund structures than you would have seen in 2007, 8.
I think Jeremy kind of covered it, but I would further to that leverage is great until it isn't. We're very conservative with the use of leverage. We have unlevered funds as well as levered funds, but we're talking very low loan to value. At the end of the day, when the opportunities appear, you have to have the cash, and you can't be off balance to take those opportunities. And I guess over leverage is it's the road to having trouble.
Being a banker, I would say leverage have to be used for the purpose that leverage is. It's CapEx, it's long-term strategy. When you leverage in the short term, you're gonna get in trouble because even though if you put collateral or you put covenants, when you hit the covenants, it's too late. You have to refinance, you have to restructure, you have to waive you don't react on time. So it's like, I've been in the industry in general, banks, funds, we're not using the right product for the right needs. It's just been very opportunistic, and there is a lot of, I would say, issues today because there is a lot of liquidity. Largest banks are pumping out of the liquidity. Funds are sitting a lot of liquidity. Everyone is waiting for the big game to the big return, but we forget about the basics. And again, that's why I love my program. I'm very passionate about trade finance. Like, this is a core business. You need to understand what is the need of the supplier, what is the need of the client, and how the business grow. If you go too fast, you run out of cash, you're going to be in trouble. If you go too slow, the competition is going to take over your business. So when you are in the supply chain cycle, you understand what is the need of a company. You spend almost every week on the phone with the treasurer, with the CFO, what is going to grow. And then if they have to do an acquisition or merge, use the right product. That's when you use leverage. You don't use leverage for your day-to-day business. That's when you get in trouble.
And I would tell you, quite honestly, as a lender, I mean, you got to be disciplined and lend to situations where there's margin and that your rate and your cost of capital doesn't put somebody upside down. So I think at every part of the chain, leverage isn't bad. Buying assets isn't bad. Having a fund structure isn't bad. It's only bad when, depending on the volatility of the underlying assets, if they don't match, or the margins in the asset don't match the advance rate or the price or the leverage. And so none of them are bad. It's just you have to be disciplined with the approach you take with all those components.
Yeah, and I'll just add a little bit more to what I said earlier and what was just said here. So again, working on the prime broker side for almost 20 years, lending out tens of billions of dollars to managers across the spectrum, including hedge funds and some of the largest asset managers like the PIMCOs, WAMCOs, double lines of the world. In that space, the lending typically on Wall Street at the banks comes off the prime brokerage desk, the margin desk, which the spreads are typically on the equities like around LIBOR, Fed funds plus 25 bips up to maybe non-secured bonds, maybe like around 100, which most of the managers thinks LIBOR plus 100 are wide spreads. In this asset class, it's LIBOR plus 300 on a good day, done off the structure desk. And so when you're looking at using leverage, it's very restrictive. The cost of leverage is high. The covenants around what verticals you could leverage up are very strict. And typically leverage is provided within the consumer space. And the banks typically like to provide leverage off the largest platforms that have been referenced already on this panel, including myself. If you're paying leverage costs kind of in the 5% range, but the asset that you're ultimately investing in is only returning 6%, most people would kind of say that the risk premium for that isn't probably where it should be, where interest rates are today, and the covenants that are there. And so there's a lot of aspects when it comes to providing leverage. And if you're getting leverage on 3 to 5 year loans, is much different than maybe providing leverage on a real estate bridge loan that might be a 12-month term. So the factors when it comes to managing assets using leverage in this space are way different than what I was used to living in my prior life when it comes to liquid assets that clear through DTC that could easily be able to get called if need be. The assets here are level 3 assets, which are way different. And so that's why a lot of people, I think simplistically like to say, well, why not just leverage it up? Well, it's easy to say, but to do in practice from all different facets is a way different animal. And I mean, one last data point. Like I said, I personally invest a lot of money in this asset class, both within our own funds and third-party funds. There's a fund, I just got notification, I won't mention it out of respect for that organization, but they're an originator. They have their own proprietary fund. They use leverage, and they themselves are now shutting down the fund because of not just leverage issues, but a whole culmination of issues, including leverage costs. So if an originator has their own proprietary fund and has issues around leverage, just imagine how difficult it is for fund managers that are trying to do the same thing. And
I think that's the interesting part of of the panel that I think there is more opportunity of co-investment between the banking industry and the fund in order that each of us have the space that that continue to leverage funds. I think it's more a partnership based on the product, on the need of the market, than just putting more money on the fund and get the leverage that probably can kill some of the fund, because there is a need for the buff industry right now, and the fund has been taking a lot of the bank business, unfortunately because of the regulator in 2009, but without sometimes the right tools or the right capacities, and the banking have been getting away from risk, but they just go behind the scene and leverage the fund, and so the issue is still there. So I think the partnership and some co-investment, there is some business that's still for the banks, and there are some business still for the fund, but we need to work together to bring a solution to the market, because at the end, what we need is corporation to continue to grow in order to generate wealth. Company in distress, you can make a lot of money, but that doesn't generate wealth in the long term.
Hey, one last very quick
Go ahead.
one, sorry, I was meeting with the $23 billion allocator earlier today before I came here. And I think the solution for those that really want to have leverage is that across allocators, or even frankly some other managers, if they have liquid pools of assets, of equities or bonds, it's, as I mentioned, a lot cheaper and easier to get leverage off that. And then you could always transfer that leverage when it comes to making allocations to strategies like this. That's one solution that we're seeing allocators do to get around the leverage issue for those that want that exposure. Go ahead, Liz.
I was going to say, other than leverage, what other tools are we seeing? I think one item we talked about, and we've talked about here, is technology that we think are interesting and really differentiate, and are things that the co-investors and people who are thinking of coming in on opportunities ought to think about as part of their investment diligence.
There's no question that technology is providing, mass data and machine learning and those types of technologies that are helping develop also alternative facts that help you make a credit decision. But, all that stuff is great, but, we're sort of old-fashioned lenders, and I look at some of the companies and I would ask the question, how many people there have any experience working out an asset or working out a loan? And so I think technology can help you. It can help from a data perspective. It can help from a credit aggregation information basis. But the people that make the credit decisions and sort of man those software packages and those technologies, they need to have the experience set as lenders and buyers of assets, so that when things go awry, they actually understand the issues that one needs to know when you need to work out a bad loan. Because somewhere along the line, you will work out a bad loan, and technology won't be able to bail you out just on a technology basis. You're going to need the human capital that knows how to use that data and those tools to salvage a bad situation.
I work with a lot of fintechs, and I'm been exploring. I'm against develop banking are investing a lot of money in IT, and they have the huge IT department compliance. We spend a ton of money instead of understanding our client. We just to fix our becoming IT companies. I think it's a big mistake. There is very excellent fintechs outside, and I agree. They need more in their area, some financial guys that work in the fintechs. And it's happening. A lot of bankers are moving to the fintechs right now. The fintech understood that they need people that are savvy in the banking industry in order to bring a better, but it's a tool. It's like if you try to drive a Ferrari in the middle of the desert, it's not going to work. So you always need to have the right tool for the right decision. And I think technology is helping tremendously. And in the case of supply chain, is that interconnectivity. They connect you direct to the ERP system. I can see immediately the cash available, the company. I can get ratios. We are in the middle of a huge transformation. Blockchain is going to help from the KYC process and to be sure that an invoice is a real invoice. It's not duplicated. It's going to take still time, but I agree. If you don't have the right tool, but then you don't have the right people to understand the tool, it's driving a Ferrari in the middle of the desert. It's not going to work.
The only thing I'll add with regards to technology is that the traditional tools that Wall Street uses, Bloomberg, Riskmetrics, Advent, these portfolio management reporting systems, none of that exists and is applicable to the P2P marketplace lending and the specialty credit asset class. You go to Bloomberg, you're not going to find barely anything except for a few of the securitizations that exist out there. And so, in terms of technology, it's critically important that managers have the right portfolio management reporting tools, the right custodian, the right administrator, and we invest heavily within that space to make sure that the investors again have peace and soundness for when they allocate assets to us. Which again sounds simple, but when I worked on the sales side when I first moved into this asset class and worked for these firms, there so many managers were saying, "How come I can't raise money?" And for me, it was fairly obvious because you don't have the infrastructure that's needed to get allocations and check those boxes from these investors that demand it when it comes to making these sort of allocations. So from my perspective, the technology is a slightly different animal than maybe what was being referenced here, but still critically important when it comes to successfully managing assets within the space.
So, yeah, do you have anything?
I was going to add that where I find technology and innovation is, for me, the disruption that it creates and sort of changing the rules. That's where I see the opportunity. But to everyone's point, technology for the sake of technology itself isn't the gating item. The one example I'd say outside of compliance and security and in the consumer debt space, the first portfolios were sold during the savings and loan crisis of the 80s. And while technology has changed somewhat, it really is, it's still people, collectors, humans, calling and reaching out to the person they're trying to collect from with a phone. There's some sophistication in there, but it's pretty much what's happened. The trend, one technology trend I would point out is a growing debtor is your millennial. Well, the millennial doesn't have a landline. They have a cell phone. The laws and rules for contacting people by cell phone is different than landline. They also don't want to pick up the phone. Someone mentioned artificial intelligence and machine learning, where the average agent may be handling a couple hundred files at one time. You're seeing agencies that are 95% of the encounter is all artificial AI, and you have 4 people that are overseeing 100,000 files. And that's where I think, on the technology side, at the end of the day, that disruption that it creates, that for me that's where it's interesting.
And I'll agree with that. In that space, as an example, we have a couple operating companies that we own in the collection space. And what you won't believe is if you get a call from a collection agency or even some of the outbound consumer-related marketing efforts, you might think the AI is advanced to the point where you actually think you're talking to a human, and you're not talking to a human. And if it goes off script, it immediately shoots to a manager so that the manager can finish the talk off. And what does that mean? That means the technology is going to make it cheaper to collect, which means people are going to pay more for the debt, or they're going to get the same opportunity and get a better margin because that technology allows them to collect it cheaper. So I think technology can be looked at in a number of ways.
Okay, talking about technology, crystal ball looking, what do we think are opportunities that are in the next, or what do we think is going to happen in the next 18 months? Do we think there's actually going to be a down cycle?
I guess I hit unmute first, so I'll go first. Sure. I mean, I'm not smart enough to know exactly where we're at in the credit cycle, to be honest with you, but I think most people think we're probably in the late stages, at least maybe on the consumer side, getting into late stages on the real estate side. But that being said, I mean, people always say, is there dry powder? But the reality is people are always chasing yield. I don't care where you're at in the credit cycle. People are always out there trying to find yield, no matter whether you're early or late in it. And there's always a lot of competition for yield. And we're out there constantly trying to find it. And I think There are interesting opportunities. I mentioned a couple kind of in the opening remarks. One interesting opportunity that we're invested in. I won't mention their name. It's public, but it's two ex-Goldman guys. They're trying to be the WeWork of residential living. So they have investments here in New York City, LA, San Francisco, Chicago, San Diego. Make it very easy, primarily for millennials, to move residences. As a lot of these millennials get access to jobs, so they could have lease terms from 4 months to 12 months. And they act as a master tenant, and then they sublease the rooms and collect the spread. But then they need a line of credit to go out there and collect more leases. And so this is a firm that has the right funding from the right VCs. We've done a lot of counterparty risk on them, have all the right covenants and escrow accounts to capture the payments, and we get a very, very nice yield, especially relative to where we're at in the marketplace today. So it's having those sort of opportunities, again, trying to leverage the brand and the reputation and the size and try to be good partners that we're out there constantly speaking to those types of firms and getting close to making a couple more investments. Today, across the 4 primary funds, we have about 13 different originators that we purchase from and are constantly trying to find new ones, and we think are having some success around that. And that goes for, again, consumer, because even though this is people are living in the real estate, it is a consumer play, because ultimately it's the consumer credit that if the tenants don't pay, then there's a problem. But that's a consumer play, even though most people intuitively might think of it as a real estate play. But we're seeing opportunities like that on the consumer side. We're still seeing some niche opportunities on the real estate side. And I mentioned previously we're invested in litigation finance and life settlements, which we like a lot as well. But there's always opportunities out there, whether it's today, and we think it's going to be the case going out 12 months. But there's always competition for every deal we go after, and it's not easy.
We're sort of sitting around and waiting for some of the small to mid-sized groups that are halfway where they need to be. And over the next 18, to 12 to 24 months, there's going to be some opportunities to be a liquidity provider, because there's going to be groups in some of these different asset classes that are stuck. And so we think there'll be some opportunities to do some bailout financing in the specialty finance space to be a net liquidity provider. But as far as the cycle, I don't think any of us would be sitting here now if we knew when that was going to end. But I think, as we all know, there's a number of different things that can contribute to that. The election in 2020, all the geopolitical risk, where rates are, how's the Fed going to really behave? All these different things are what make markets. But clearly, it's the longest expansion we've had. We are definitely in the later innings. And so I think you just have to approach your business assuming that we are in the late innings and, protect your downside.
The way I see it's not a down cycle. I see more a transformation cycle. I think we're human beings, so AI is helping us to do all those jobs that we don't want to do anymore, and that's going to help all that doesn't add value. I think as human beings, we're looking for more, and I set aside the politics, because that doesn't change what is the reality today. Human want customer experience. When I talk to some of the clients, Miami based, so a lot of bankers or private bankers, all my friends are private bankers. When you talk to their investor, they want to understand what they're investing. They want to be part of the show. They want to be part of the game. Now they demand more of us, my CFO, my treasurer, they demand more of my time. How you feel about my company? So we have technology free us time to become human back again. We don't need to be in the factory and putting chips. We don't need changing tires. There is a lot of things. We don't even go to supermarkets sometimes, even branches. If you see the bank industry, no one go to a branch, but everyone want to see a branch. That's how human we are. Like, we want to see that branch over there, even if it's empty, because we feel that it's an institution behind. We want to see the building. We want to still own a house. We don't need it. I'm not talking a secondary house, not a primary. You need a roof at least. We have Airbnb, so we can have a house everywhere in the world if we wanted, for less than we spend in our secondary houses. So we're still human, and I think that's the transformation. It's not a downside, it's to transform how we interact with each other and how we start doing business. I'm mentoring a lot of millennials, and that's what they're looking for. It's no longer like had the mansion. It's their experience. They want to travel the world. They want to move. So politics divide us, but at the end, it's one word and it's connected. And I have, through my career and dealing with some baby boomers at a time in Miami, say, "Why are you doing business in Chile? Let's do it." Say, "Well, this company in Chile, if something happened, I would know in 24 hours. The guy in Hialeah, you're not going to know that he's screwing the bank maybe in 2 or 3 months." So that's how connected we are today. I have 2 young kids, and people say, "Oh, yeah, they spend too much time on technology." This kid can connect 100 friends of theirs in a second. I cannot call 100 of my friends in a second today. And I'm very technology savvy. When there has been the mass shooting in South Florida, this kid organized themselves in minutes. That's the power of technology and the human side that we're forgetting. We think like technology is going to replace human. No, we're human. We're stubborn. And that's what in the financial industry we're forgetting. We need to go back, and another, I'm a young banker, let's say, we need to go to the basic. We are a trust business. People trust us. We are the expert. Like the lawyer. Lawyers have been replaced by AI? No, it's not lawyer. It's the back office of the lawyer. You still need to talk with the lawyer. Doctor being replaced by robots? No, you really need to talk to your doctor. Probably the robots don't want to do the operation because it's not have shaking hands or having a drink last night. You're going to do better than the doctor, but you still want your doctor there. So it's that simple. Like people are afraid of technology. No, it's not a downside. It's a transformation side, and you're going to be on board or you're going to be out. That's what's going to happen. That's at least my view.
All right.
Crystal ball, whatever you want.
I mean, following Shalako, that was very
hard.
it's hard. And I don't want to come across as callous or insensitive, but I don't have any predictions on when the down market is, but I could use I could use a correction. That's where the opportunities come. And in the meantime, we stick to our knitting and we're shooting for singles and doubles. And but yeah, agree. I want my surgeon to be human too.
On that note, does anyone, I think we're going to turn it over to the audience. Does anyone have any questions? Go ahead.
So we had SNL and '08. Those are the 2 blessings we've been hit with at the moment recently. Currently, because of '08, the big banks have gone up market, and that created opportunities for you guys, except for the bank part, unregulated. Do you see a situation, and regulation didn't work out so well either. That's one of the points. Therefore, are we looking at a potential bubble with unregulated components in the market now that have taken over a significant role of financing that is not regulated? And what could happen, and what do you perceive is a potential bubble that might occur because of that or because of other reasons?
From the banker side, this is the thing, and again, that's a personal view. There's 2 things that are happening. 2009 heard a lot on the too big to fail. Now it's worse. And basically, all the largest institutions are pumping all the cash, and they're becoming fee banks. There is no more risk management. There is not a risk culture anymore in the largest bank. They just want your cash, turn around the cash of the fund, and just charge a fee. They are not supporting you. Regional banks have a lot of pressure because we are the one, and you see in the other panel, we are the one supporting a lot of the fund. It's not the largest bank anymore. They just want to handle your cash. And they give an amazing platform, amazing product that is very difficult to compete for a community bank or a mid-sized bank. And you love your Chase, your Wells Fargo application that other banks cannot have it because we don't have the resources. And then we start losing that liquidity. So I think right now the fund industry, unregulated, is doing a tremendous job. They're much more savvy than before. They're becoming a little risk adverse. That's going to affect the economy because if larger banks don't lend, middle bank, we don't have the powder and the cheap funding anymore then the opportunities for funds, and then that's where I joined this panel, co-investment. So we need to work together in order to turn around again and create this economy that add value. So yes, there is a bubble in a way that funds are being more aggressive, but it's not like real bubble. It's the opportunities there. It's not, you're not creating an opportunity like we do with the housing industry, because that was everything and everything I read around. That was a manipulation of the market. It was like you talk about taxi driver flipping houses, but you see the movie. Even a stripper were flipping houses. So that doesn't make any economic sense. That people with low salary can turn around 3 or 4 houses and make a fortune. That was artificial created. Right now, what you do as funds is not artificial. The business is there, the need is there. We are struggling with the cost of funds. We're struggling with the return that our clients wanted. Yeah, it's like in the bank industry, we're more focused on what is the perception of Wall Street of our return. They're not thinking what is our job to create that, because banks are the heart of the economy. And that's why we save the bank with all our taxes. It's because without bank, and it's not a business that's going to disappear. There is no way that all of us work it out. We don't move the money. We don't have all that. So I don't see a bubble. I see a structural issue, and funds are taking over that and getting more savvy. And conference like this is very important, I think, because they put all you together and see what each other doing. That with bankers we do. Credit officers, they don't talk to each other, and that's been. I'm struggling through the industry that I want conference with credit officer, underwriter, go to a conference and talk to each other. Fund talk to each other. Private equity talk to each other. But family office talk to each other. They even have conference for business guys talk to each other. But the credit guys, they just are in the bubble, like the credit agencies. Each of them have the bubble. If you talk to a Moody's or Standard & Poor's and Fitch, they always have different opinions. Yeah.
I know we're short on time, and I'll try to answer the question. I'll be 20 seconds. I just came back from Asia, had 12 meetings. Everyone asked a similar type question. But my 2 cents on it is this. It's the reason why this asset class from private debt, P2P, exists is because these fintech companies are doing it quicker and cheaper than the banks are. I think most people don't debate that. Second thing most people don't debate is that the government actually is for it. Whenever you have companies that try to help consumers reduce their amount of interest they pay, and also help small businesses get access to capital and also to buy real estate, the government is actually in favor of that, but they want to regulate it. And it is a little bit of a misperception that this industry is actually very heavily regulated. So the culmination of those 3 things, I think the industry is going to continue to thrive, which it has been, and most people, I think, would agree with that, with those macro events that are happening. I'll probably have room for a couple, 1 or 2 more questions.
And I would also argue that the risk is spread in a way more diverse basis. The banks are way better funded and under-leveraged at this part of the cycle. So for you know, I don't know why they call it, instead of the sunny banking system, the shadow banking system. But now instead of depositors taking that risk, you know, informed investors are taking that risk that are better educated, and there's a better spread of risk, and the depositors aren't taking that risk. You know, my view on the, you know, along with some others, is some of the unraveling in the middle market and leverage loan market with covenants and the corporate debt side. You know, a lot of the folks that I read and visit about think that the downturn on the credit side will be led by some of the corporate exposure that exists today, and that corporate exposure is more concentrated and will be harder to refinance.
Is there anyone else, or should we wrap up?
Do you have any more?
Anyone else? All right, I guess on that note, thank you.